Rent of a similar property in the same locality is 2 lakhs. This is nothing but your fair rental value. Rent which is not recovered by the assessee during the previous year, where the property was not let out, it was totally vacant or empty. Fair rental value, municipal rental value. Fair rental value is 2 lakh and municipal rental value is 1 lakh 65. In these two, whichever is greater is 2 lakh. Warm welcome to 5th Sem BBA students. We are into the session 2 of income from house property. In session 1, we learned about taxable income from house property and exempted income from house property and how to compute the gross annual value. In today's session, further we are going to solve the problems where you can understand and you can clear your paper easily by getting center marks from the subject. The first problem we have taken here, I am Mr. A, owner of house property in Delhi. The construction of the property was completed on 30th November 2018. When I have completed in the year 30th November 2018. So if there is any pre-construction interest, say here from 2018, 19, 19, 20, 20, 21, 22, 23, 21, 22. So 5 years are there. So the 5th year this is the last year where you can claim the benefit of pre-construction interest if it is there in the problem. So he is eligible for pre-construction interest. The property consists of 4 units. Actual rent received for each unit is 48,000 per annum. So what they are saying that one, I have 4 units of property here. For each unit, means for example, it may be, we have taken here ground floor, first floor, second floor and third floor. So the property is divided in such a way that when 4 units, for each unit I'm getting 48,000 per annum. Per annum it is 48,000 for each unit, means ground floor 48, first floor 48, second floor 48 and third floor 48,000 per annum. Standard rent of the property under the Delhi Control Act is 2,20,000. For the entire premises, the standard rent is 2,20,000. Next one, municipal valuation of the property. For the entire property, municipal rental value is 1,65,000. Next, rent of a similar property in the same locality is 2 lakhs. This is nothing but your fair rental value. Fair rental value is 2 lakhs. Fair rental value is 2 lakhs. Municipal rental value is 1,65,000. Standard rent is 2,20,000. And actual rent, what we have received is 1,92,000. 1,92,000, add all the thing, 8 plus 8, 16, 24, 32, 2, 3 carry, 1, 2, 3, 4, 16 plus 3, 19. So 1,92,000 is the amount actual rent, whatever I have received during previous year. During previous year, municipal tax was paid on the entire property by Mr. A, that is me, the owner of the property, 35,000. So eligible for deduction, that is we are going to deduct from our gross annual value whatever the municipal tax paid on the property. 3 units of the property was residential purposes and 1 for professional purpose. Find out the annual value of the property for the assessment year 2023-24. Gross annual value is 2 lakhs and less municipal tax paid is 35,000. Annual value of the house property is 1,65,000. Sir, how we got this 2 lakhs? How we got this 2 lakhs here? Note, gross annual value is computed like here. Municipal rental value is 1,65,000 or fair rental value is 2 lakhs, whichever is more. Fair rental value, municipal rental value. Fair rental value is 2 lakh and municipal rental value is 1,65,000. In these two, whichever is greater is 2 lakh. Standard rent is 2,20,000. Standard rent is 2,20,000. In these two, whichever is less. So it is 2 lakhs. And next, actual rent, 1,92,000, whichever is more is my expected rental value or gross annual value. That is 2 lakhs is the amount considered for the calculation. Next, in the problem 2, we have taken 4 different concepts here. We have here property A, property B, property C and property D here. Municipal value 1,20,000, 96,000, 72,000, 1,92,000 and fair rental value, actual rent, standard rent that are given here and municipal taxes paid by the owner of the property. So here 1,20,000, 96,000, 72,000 and 1,92,000 is my municipal value and fair rental value is 1,50,000, 1,20,000, 90,000 and 2,32,000. In these two, whichever is higher, that we made comparison with the standard rent. Expect 1 or 2, whichever is more, greater than but not more than the standard rent here. So now 1,50,000 here and 1,20,000 and here it is 84,000 and here it is 2,30,000. Greater but not more than the standard. They're saying that one, it should not be more than the standard rent, whatever we have here. Next one, actual rent is 1 lakh. Whatever they are given here, we have considered gross annual value for the actual rent. What we have here, 1,38,000, 1,08,000, 8,000 and 2,40,000. So now, whichever is greater. In these two, whichever is greater is 1,50,000. In these two, 1,20,000. And in these two, 84,000. In these two, 2,40,000. This is my gross annual value. This is my gross annual value. And here, from the gross annual value, municipal taxes will be deducted. 12,000, 9,600, 7,200 and 19,200. So 1,38,000, 1,10,400, 76,800, 2,20,800. This is how we are to calculate the net annual value for the problems. The third problem we have taken here, compute the annual value of the house property. Municipal value 4 lakh, fair rent 3,60,000, standard rent 4,50,000 and actual rent is 50,000 per month. So 50,000 into 12, so it will be 6 lakhs. So it will be 6 lakhs per annum. Expected rent is 4 lakh, actual rent is 6 lakhs and there was a vacant period. Vacant period was there for 2 months. 50,000 into 2, so it will be 1 lakh. Vacant period rent is a rent which is not recovered by the assessee during the previous year where the property was not let out. It was totally vacant or empty. So for that, he has not recovered any income that should be deducted from the actual rent. So now actual rent is 6 lakhs minus 1 lakh for the vacancy period. So it will be 5 lakhs here. So now in these two, whichever is higher will be considered. So 5 lakhs here. And next, less municipal tax paid, 25,000. Owner realized the rent for the year 2019 and 20, 50,000. Add both the things and deduct from 5 lakh here. So it will be, see here, now this is 4,25,000. I have to minus 5 lakh minus 25,000. So it will be 4,75,000. 4,75,000. And next, owner unrealized rent paid by the owner. And next we have here unrealized rent, which the rent is not realized for 1 month. Deduct 50,000. So it will be 4,25,000 is the amount what we are going to pay and consider for the calculation of the income from house property. Mr. Mohan owns a house property. Its annual letting value is 80,000. And during the previous year, it was monthly rent of 7,000. 7,000 into 12, that is 84,000. Municipal taxes paid, 8,000. Expenses for the recovery of the rent, 600. Ignore. Maintenance allowance paid by the stepmother, rupees 12,000 annually, which was charged on the property according to his father's will. The house remained vacant for 1 month means, see here, 7,000, whatever we have here. So 7,000 into 12 we met 84,000. 84,000 minus 7,000, 1 month vacant. So it will be 77,000. 77,000 will be my gross annual value, less municipal tax paid 8,000. So 77 minus 8, 69,000. 69,000 minus 30% on 69, 69,000 into 30 by 100, 0, 0, 0, 0. 3 zeros are 0, 3 zeros are 0, 3 nines are 27 to carry. So 20,700 will be the deduction. Out of 69,000, 20,700 is deducted. 48,200 is my taxable income from house property. This is how we're going to calculate the taxable income from house property. Gross annual value less municipal tax paid by the owner of the property. Then whatever the annual value we are going to get, 30% on that one, and including interest on loan if it is there. Fair market rent is 80,000, actual rent is 72,000, municipal valuation 50,000, standard rent is 60,000, municipal taxes 20%, 20% of 50,000, that is 50,000 into 20 by 100, 0, 0 get cancels here. So 5,000 into 2, so it will be 10,000 will be the municipal tax. And next, interest paid is 18,000. So now municipal value is 50,000, fair rent is 80,000 and standard rent is 60,000. In these two, whichever is highest, and next in these two, 80,000 was the highest, 80 or 60. So whichever is less, 60,000, 60,000 or 72,000, whichever is higher. So 72,000 is my gross annual value. Municipal tax, 20% of 50,000, 10,000. So my net annual value will be 62,000. 30%, that is 62,000 into 30 by 100. 0, 0 get cancels here. 3 zeros are 0. 3 zeros are 0. 3 twos are 6, 3 6 are 18, 18,600 and interest is 18, 36,600 out of 62 minus 36,600, we will get 25,400. This is the taxable amount in the hands of the assessee. Sixth problem. Bansal owns a house property in Pune which is let out for rupees 8,000 per month. So 8,000 into 12, so it will be 96,000. Next, municipal valuation and municipal taxes are, municipal value is 80,000 and 30% is the municipal taxes. 80,000 into 30 by 100, so 8,000 into 3, so it will be 24,000 is the municipal taxes. Mr. Bansal paid municipal taxes of past 4 years along with the current previous year. Other expenses relating to the property are as follows. Repair and insurance premium, ignore. Interest on purchase of house, 42,000. The house was vacant for 3 months. So it is 8,000 into 3. I couldn't recover 24,000 during previous year. Compute taxable income from house property. This is the thing what they have given. Actual rent we are going to consider for 9 months because 3 months was the vacant year. 72,000 or 80,000. So that will be our gross annual value. Less municipal tax paid year. Municipal tax paid by the assessee will be 24,000 plus 24,000. Is the municipal tax, whatever he has paid here, into 96,000 for last 4 years and current year it is 24. So totally he has paid 1,20,000. So annual value will be minus 48,000. Deduction cannot be calculated because it is a minus figure. Minus 48 and we have interest paid is 42,000. Minus 48 minus 42 will be minus 90,000. It is a loss from house property, 90,000, whatever we have here. Problem number 7, the date of completion of house they are given means, so we have here pre-construction interest may be there. So we have to check that one, whether pre-construction interest is eligible or not. Use of house, self-occupied, and it is let out. So if it is self-occupied property, we are not going to calculate gross annual value. Gross annual value, always it will be nil. Only for the let out property, we are going to calculate gross annual value. Self-occupied property, the house 1 we have taken here, always my gross annual value will be nil, and even my net annual value is nil. Less interest, whatever I paid here. So interest was paid on the property was 30,000. That has to be considered here. So loss from house property, the self-occupied property was 30,000. Loss from house property A is 30,000. So this is minus figure 30,000 what we have. Next one, for the let out property, municipal rental value or fair rental value, whichever is higher. So in these two, 90,000 and 65,000. In these two, whichever is less, 65,000 will be considered. 65,000 or actual rent, whichever is higher, 65,000 or 1,20,000, whichever is higher, is my gross annual value. Gross annual value less municipal tax paid, 8,000 minus 8,000, so 1,12,000. So now here 1,12,000 into 30 by 100, 0, 0, 0, 0. 3 zeros are 0, 3 zeros are 0, 3 twos are 6, 3 ones are 3, 3 ones are 33,600, and interest paid is 40. So total amount is 73,600. Out of 1,12,000, deduct 73,600. So income from house property from B will be 38,400. Now, loss from house property A is 30,000. Income from house property B is plus 38,400. Taxable income from house property will be 38,400 minus 38,400. So this is how we have to calculate the taxable income from house property if we have more than one house. House 1 and house 2, there are two houses are there. Municipal value, fair rental value, standard rent, municipal tax paid. Tax paid, how much we have here? 10%. 10% of 60,000. 60,000, 10% into 10 by 100. So it will be 6,000. And here 30,000 into 10 by 100. So it will be 3,000. And next, fire insurance premium paid, ignored. We should not consider. Loan for house construction is 9,44,000. Date of loan, when we have borrowed, 2018. Rate of interest, 15%. Interest is 1,41,600. Date of completion is 10th March 2019. So is eligible to claim the pre-construction interest. House 1 is self-occupied. So there are two houses are there. So house 1 is self-occupied and house 2 is let out. House 1 is self-occupied here. So annual value will be nil. Interest up to 2 lakhs or 1,40,000. See here, for self-occupied property, interest paid or maximum limit 2 lakhs, whichever is less. So 2 lakhs or 1,41,000 in these two, whichever is less, is eligible for the deduction. Now, next one, house 2, self-occupied annual value. If we consider house 2 also, so 2 lakh or interest paid 1,41,000. So whatever we have there, so will be considered for the calculation. So there is a loss of 1,41,600. Kumar uses 2 houses for his residential purpose. His residential purpose means both the houses are self-occupied property here. So now house 2 is also self-occupied. Annual value will be nil. And here no deduction will be there. Interest will be 2 lakh or 1,41,000, whichever is less. So totally the loss is 1,41,600 from the house property of the assessee for the assessment year 2023-24. Next one we have here, Lakshmi is the owner of 3 houses, house 1, house 2, house 3. And construction was completed 2015 and 19 and 2020, 3 residential units let out. And here, purpose of use let out for bank. So it is a self-occupied, 3 residential units let out. Actual rent 15,000 and 1,000 per unit per month. So 1,000 into 3 into 12. Next one, municipal valuation 16,000, 12,000 and 30,000. Municipal tax paid 1,600, 1,200 and 3,000. Municipal tax paid by the Lakshmi 800, 1,200, 3,000. See here, total municipal tax is 1,600, 1,200, 3,000. But paid by assessee was 800, 1,200 and 3,000. Municipal tax due or municipal tax paid by the tenant is 800. Ignore this information. Fire insurance premium, percentage of municipal valuation, ignore this information. Interest on loan taken for renewal of the house, 7,000. Now, house 1 is let out to bank. So your gross annual value will be 16,000. Less municipal tax paid by the owner was 800, 15,200, less 30%, 15,200 into 30 by 100, 0. So it will be 0, 6, 15, 1 carry, 4,560. So from the house 1, it is 10,640 is the income. House 2 is self-occupied, annual value will be nil. Less interest on loan is 7,000 and loss from house property for house 2 will be minus 7,000 here. House 3 is the let out for purpose here, 30,000 or actual rent is 36,000, whichever is greater, 36,000. Less municipal tax paid by the owner, 3,000, 33,000. 33,000 is my annual value. So 30% of annual value, 33,000 into 30 by 100, 0. 3 zeros are 0, 3 0 0, 3 3s are 9, 3 3s are 9. So 9,900, 23,700. So income from third house is 23,000. Now house 1, house 2, house 3. House 3, we have here income from house property 23,000. House 2, loss from house property minus 7,000. House 1, income from house property, we have 10,640. 10,640. Now, the total we have here 33,640 minus 7. So, it will be 26,640 will be the taxable amount, will be the taxable income from house property. House 1 is income plus sign. House 2 is loss minus sign. House 3 is income plus sign. So 23 plus 10,640 will be 33,640 minus 7, 26,640 is the taxable amount. Thank you to all our 5th Sem BBA students. The session is completed here and we have given all the information for the students about how to compute gross annual value, and even we are given the information in such a way that whatever things are discussed here, go through that one and solve the problem easily. Namaste and thank you.